Hello everybody. Welcome to the video on investment banking interview questions and answers from Career Right. The four most important topics that interviewers usually like to touch upon during an interview for investment banking positions are: number 1, basic accounting and financial concepts; number 2, valuation methodologies; number 3, financial modeling; and number 4, mergers and acquisitions. The first topic, basic accounting and financial concepts, is covered at length in these two videos that are currently showing up on your screen. The links to both of these videos are provided in the description box below. You can watch them after finishing this video. In today's video, let us focus on some very basic and important questions from valuation methodologies that are usually asked during the interviews, and you must be prepared to answer them. As for the remaining two topics, we'll cover them very soon in the upcoming videos. So if you're really serious about cracking your next interview, make sure that you watch not just today's video, but also this complete series in the playlist without skipping any parts of it. Ready? Fantastic. Let's start with our questions now. Question number 1. What is valuation? Very basic question with which interviewers usually like to open up the discussion on this topic. To answer this question, you can say, valuation is the quantitative process of ascertaining the current or projected worth of a company or asset, asking for an investment of any form. The valuation of a company depends on various factors such as its sector, geography, capital structure, management, prospects of future earnings, economic events, competitors, etc. Valuation serves various purposes, such as getting the investors, selling or purchasing a company, selling off the assets or a portion of the business, when a partner is exiting the business, and for inheritance also. This valuation can be done using absolute valuation models or relative valuation models. So you see, I've provided a little detailed information about valuation in my answer, which most of the candidates won't do. And here lies my secret to standing out of the crowd. Okay, now we just talked about absolute valuation model and relative valuation models. The follow-up question for you could be, what is the difference between absolute value and relative value of a company? Now see, if you look carefully, the terms here are quite self-explanatory. Absolute value, which is also called as intrinsic value, is company's worth based on its own projected cash flow. There's no comparison with any outside company here. This method helps the investors understand if a stock is currently overvalued or undervalued. And based on this understanding, they make their buying or selling decisions. Discounted cash flow or DCF analysis is a primary method used for absolute valuation. Some examples of methods used for DCF model include dividend discount method, discounted asset model, discounted residual income method, discounted free cash flow. Some of the major challenges involved in working out an absolute value include difficulties in forecasting the cash flows, accurate growth rates, and appropriate discount rates. Now coming to relative value. As the name suggests, this valuation is in relation to something. So here you compare the similar assets or similar companies in the same industry to determine their value. This comparison is based on certain multiples. For example, if you are interested in investing in a retail chain, you would compare chains like Star Market, Reliance Mart, D-Mart, etc. Some of the common methods used for relative valuation are CCA, that is comparable company analysis, peer group analysis, transaction multiples analysis, etc. The common multiples used for making the comparison are PE ratio, PB ratio, EV to EBITDA ratio, EV to sales ratio, EV to EBIT ratio, etc. Now, an important question that arises many a times here is the factors you consider while selecting the comparable companies. It's a good idea to brush up your knowledge on them also. So, the important factors usually considered while selecting the comparable companies are: number 1, industry and sector, as your study would only make sense if you are comparing the similar entities. The second one is size and scale. They are very important. Number 3, business model, growth prospects and financial performance. They also matter a lot. Okay, let's move on to the next question now. Question number 3. What is the difference between valuation and pricing? Okay, a very important question. Valuation here refers to the process of determining the intrinsic worth of an asset or company based on factors like financial performance, future cash flows, market conditions, etc. The aim here is to estimate the fair value of the asset or company, while pricing refers to the actual market value at which an asset or company is bought or sold in the market. The factors that influence pricing are the dynamics between supply and demand, investor sentiment, domestic and global market factors, etc. So basically, valuation focuses on the fundamental analysis to determine the true worth of an asset, while pricing is a reflection of the perception and willingness of the market to pay for that asset. Question number 4. Tell us something about DCF model. Now, discounted cash flow or DCF is a method of valuation using which you determine the value of an investment based on the returns or cash flows you expect in the future. If you see that the discounted cash flow is higher than the current cost of the investment, you term it as a good investment opportunity, else it is not. The investors usually do this calculation to understand if they should invest in a particular company or project or not. DCF is calculated using this formula. The biggest disadvantage of the DCF method is it uses estimates of discount rate and cash flows rather than actual figures. So if your estimates go wrong, your calculations go wrong. This means that if you are conservative as an analyst, you might miss upon a good investment. While if you are too liberal and ambitious, you might just pick up a loss-making deal. Moreover, future cash flows depend on a lot of external factors also, such as domestic and global economy, policies and regulations, technology, competition, and a lot of unforeseen things also. While all these things have a heavy impact, they can't be quantified exactly, making DCF vulnerable. So you see, when you give this type of detailed answers, the interviewer is able to trust your understanding of the subject and your ability to think from various angles, which is very, very important for this profession. Question number 5. What do you know about WACC? Now, WACC stands for Weighted Average Cost of Capital. In the simplest terms, it is the average rate a company expects to pay to finance its business. It expresses the return stakeholders and bondholders expect in return for the capital they provide to the company. If the stock of a company is volatile or if its debt looks risky, its WACC will be higher, as its investors expect better returns for the risk they take with this investment. WACC is also used as discount rate in future cash flows during DCF analysis. The formula to calculate WACC is listed here. The first term in the formula represents the weighted value of equity capital, while the latter represents the weighted value of debt capital. WACC is used as the hurdle rate also many a times. A hurdle rate is the lowest rate of return required on a project or investment. Higher the risk, higher is the hurdle rate. Next comes a question that demands a little practical application of your subject knowledge. Life insurance has a very high IRR initially. Explain. Now see, IRR here means internal rate of return. It is said that IRR of a life insurance policy is very high in the initial months, because if you pay just 1 or 2 premiums and you die, your beneficiaries are still entitled to the lump sum benefit, which is a huge cost to the company. Okay? Question number 7. What is comparable company analysis or CCA? Comparable company analysis is the process where you compare the companies on similar metric and try to determine their enterprise value. The valuation ratios help you understand if the company is overvalued or undervalued. CCA works in the assumption that the similar companies have similar valuation multiples like EV, EBITDA, etc. The most commonly used measures for valuation are enterprise value to sales, price to earnings, price to book, price to sales and EBITDA. If a company's valuation ratio is higher than the average of the peers, the company is overvalued and vice versa. Question number 8. How are transaction metrics used for comparable company analysis? See, transactions here refer to the acquisitions that have happened in the industry recently. You compare the multiples based on the purchase price rather than the stock here. If you notice that all the companies in the same space are being sold out at an average of 1.8 times the market value or maybe 12 times the earnings, you can use them as the benchmarks. Moving on to our question number 9 now. How do analysts identify relevant precedent transactions that can serve as benchmarks for valuation purposes? Now see, this is again a little practical question which tries to understand your logical thinking ability. You must be prepared to field some such questions also from the interviewers. To answer this particular question, talk about the step-by-step procedure you would follow. For example, your first step would be conducting industry research to understand what are the recent trends and activities happening in the market, who are the key players in the industry relevant to your target company. Then you would set up the screening criteria, right? For example, you would decide the industry, sector, size of the deal, geographic location and transaction type. What this step does is it helps you narrow down to the most relevant deals. As your step number 3, you'll start to find the transactions that meet your criteria. For this, you can utilize financial databases, transaction databases and industry reports in general. Then you would analyze your choices for their relevance. You select the relevant ones and carry out your due diligence to ensure accuracy and reliability of the data of the selected choices. So in general, this is how you would go about identifying the relevant precedent transactions that can serve as benchmarks for your valuation. Another important concept in valuation is asset-based valuation, and your next question could be about it. The question could be, tell us a bit about asset-based valuation. Now see, as the term is self-explanatory, the focus of asset-based valuation approach is on the net asset value of the company. In simplest terms, it just means total assets minus total liabilities. That is the book value of the company. But you would see that most of the times, the actual valuation of the company is different from the book value. There are two prime reasons behind this. The first one is, while trying to execute a deal, we consider a lot of intangible assets that are missing in the book value. The second one is, you try to identify the market value of the assets in the current environment. Balance sheet valuation takes depreciated value into consideration, which may be different from the market value. The same thing applies to the market value of the liabilities also. When you make all these adjustments, the ultimate value that you get is called as the adjusted net assets. Now, a follow-up question to this can be something like, in which cases do you use asset-based calculation approach? Now, to answer this question, you can say, as we have seen earlier, two most commonly used approaches for valuation are enterprise value and equity value. Both these approaches use the value of equity in the calculations. Now, for a company that doesn't have equity, asset-based valuation approach is used as an alternative. Many a times, to carry out due diligence also, in case of especially private companies, this approach is used. Many stakeholders also use it for valuation comparisons. And finally, when a company wants to liquidate itself, this approach helps it in finding the fair market value of its assets. Question number 12. What do you know about real options valuation? Now see, this just signifies that these options represent tangible strategic choices and opportunities that a company has in the real world, beyond the financial options that are traded in the markets. These options can be related to investment decisions, strategic expansions, or project management also. In financial options, the right to buy or sell the financial assets at predetermined prices is involved, while in real options, the flexibility to make the decisions that can impact a company's future cash flows or value is involved. These decisions could be about expanding into new markets, delaying investment projects, abandoning certain projects, or altering production levels as per the market conditions. Real options differ thus from financial option contracts since they involve real, that is physical, underlying assets and are not exchangeable as securities. Okay, now let's move on to another important question. Question number 13. What is SOTP valuation? How is it different from DCF analysis? Now, SOTP here stands for sum of the parts valuation. It is also called as breakup value analysis. It is the process of determining what would be the worth of individual divisions of a company if they were bought by a different company. Each segment or asset is valued based on its specific characteristics, financial performance, and market conditions. Now, pay attention. This valuation is used when a company is a conglomerate with businesses in different industries. For example, SOTP can work for companies like Tata and Reliance that have businesses in various sectors. The value of each business is separately derived and then put together. It is different from DCF analysis in the sense that DCF analysis can be used as a way to value each business of the conglomerate. SOTP works because these big companies are then able to harness the advantage of synergies. Another big advantage of SOTP is it helps in highlighting the hidden value within a conglomerate. What this does is it helps in potential re-rating of the company's stocks by the market, because now the investors recognize the true worth of its individual business segments. On the other hand, if the market conditions and dynamics change, SOTP may get affected. Question number 14. What does a negative terminal value mean? Now see, in simplest words, terminal value of any asset or company is its estimated value at the end of its useful life. It is an important part of DCF analysis. Now coming to the negative terminal value. If you see practically, a negative terminal value of an asset can't exist for a very long time. The equity of a company can fall to zero at the lowest. Any remaining liabilities will have to be sorted out in the bankruptcy proceedings. So if it ever happens that you as an investor come across a negative terminal value, it is a good idea to look at other fundamental valuation tools also. And finally, moving on to the last question for today's video. How is sensitivity analysis used in making the investments? Okay, so first of all, let us see what sensitivity analysis is. See, we conduct any analysis to understand how certain input variables affect the target variables. Sensitivity analysis allows you to estimate how a range of changes in the input variables impact the target variables or the outcome. The complexities increase with the increase in the number of variables, market conditions, formula, etc. Now coming to how is sensitivity analysis used? So it helps with making predictions about the share prices of public companies first of all. Then it also helps you with the effect of change in interest rates on bond prices. So these are some of the uses of sensitivity analysis. So basically it lets the management understand the factors that have a potential impact on the outcomes, reducing uncertainties and surprises. So what this does is it allows you to plan better for the future. So these were 15 basic but very important questions that every investment banking candidate must be prepared to answer. Make sure that you watch these videos on accounting and financial analysis also to prepare for your interview. You will definitely have some questions asked from them also during the interview. Very soon I'll get to you the videos on financial modeling and mergers and acquisitions also. To make sure that you don't miss them and other such videos, subscribe to the channel now. If you have found today's video useful, do give it a thumbs up and share it with your friends also. I'll be back to you with a new video very soon. Till then, bye-bye and take care.